Some insight on where to invest in this global marketplace. Jim McCaughan sees some compelling opportunities in investment-grade bonds and global property securities. He is CEO of Principal Global Investors, which has more than $200 billion in assets under management. Jim, welcome. Good to have you back with us.
Thank you, Carol.
You know, the president talking about the economy and the job market specifically following today's disappointing data. We talked with you back in April, and you said maybe another, I think, 6 to 12 months that it's going to still be tough for the economy. At least another 6 to 12 months will be brutal, is I think what you said.
That's right.
It has been. So what, do we still have another 6 to 8 months to go?
I think that the real issue here is that the recovery is going to be slow, and I think the word I'd use is tepid. It's not going to be the kind of rapid recovery that past recessions have seen. You know, there's a kind of a magnitude of the recovery is similar to the magnitude of the downturn. And this has been a really big downturn, but I don't think it's going to see a big recovery.
It really is different this time around.
It really is different. And I think a lot of that is to do with how much pain people have felt and how cautious the consumer is going to be for the next year or so. And I'd point to the savings rate. The recorded savings rate is up above 5%. I think it's a fair chance it will be in high single digits for the next 2 or 3 years.
So it's lasting in your view. Some folks say it's going to take a generation to really change people, make them from spenders into savers, and so this is just temporary. You don't see that?
I do not believe that, because if you talk to individual investors, 401k participants, they've been through pain. They've seen retirement plans which they thought were rock solid looking much less rock solid. They'll have to work longer than they thought, so they're putting aside more money. We see in our 401k platform that people are actually putting aside more as often as they're putting aside less. So I think there is a definite move towards more of a savings mentality, which will slow the economic upturn.
All right, but what's interesting is if they're putting more money into their 401k, to me that says that's potentially a very good backdrop for the market. It certainly has been up to this point, but yes?
And long term, that is true. What is going to happen, I suspect, here is that as people save, as the consumer doesn't spend so much, they will obviously slow the economic recovery. It won't be great if you're in consumer shares. It won't be great if you're
retail
in... It won't be great if you're in retail. It won't be great if you're an importer, because essentially I think what is happening is that people will be saving their income instead of spending it on imports. And what that means is very rapidly the US could move away from its large trade deficit, and it would be a much more sustainable recovery.
All right. But then you've also got the deficit, which has grown tremendously, very, very quickly. Lots of worries about that. Julian Robertson talking about the Chinese buying up the government debt. I know you didn't necessarily agree with what he had to say.
No, I mean, you have to respect what he says. He's got a great track record. But I do think that if people do start saving, as I expect them to, and move the savings rate up to sort of 7, 8, 9%, then you will get into a situation which is more like Japan in the 90s, where the deficit is growing, but it's able to be financed from domestic savings. And I think that actually would mean that everything was much more sustainable.
All right, but where does growth then come from ultimately? Because we know how important the consumer spending has been to overall economic growth here. I mean, where does it come from?
Well, it won't be from consumer spending.
Right.
Consumer spending got to 70% of the US economy. That's actually unsustainable. You need a more balanced economy with capital investment, infrastructure investment. And I think we're headed for what the president called a 21st century economy, more technology, more infrastructure investment. We need that, actually, and that will be a more balanced and sustainable growth.
But that takes a while to really kick in, Jim. So I'm curious, we have seen such a bounce in stocks here, tremendous, tremendous bounce. I mean, what happens? Do you still see significant gains? Give me 6 to 12 months, 1 year.
6 to 12 months out should still be okay.
What's okay?
Okay, up a bit.
Up a bit.
It won't be at 50% like the last 6 months.
10%?
Could be 10, could be 20, that sort of thing. Events will determine it, but it's basically a good tailwind for the market because, hey, the market's still a third off the peak, and we've got the inventory cycle turning. The important thing for profits over the next 6 to 12 months is how fast does the inventory cycle turn. That's about as important as consumer spending. And that's turning quite rapidly because inventories were slashed to a very low level.
Right, but the other side of that is supply is one point, but but demand is another. Do you think that demand is truly going to come back?
No, it won't come back. It won't be like 2006 again. It won't.
So there is a new normal coming?
There is. No, I believe that there's been a reset of the economy and that consumer attitudes change. And I look back to 73-4. After that market setback, which was not as bad as this one, people saved more right through till the early 80s. And I think that will happen again. And if it does, you end up with a slow but very sustainable economic recovery, which is okay for stocks.
But go back to the deficit again. It's a tremendous amount. I know that this typically happens in a recession where you build up a deficit. But as you say, it is different this time around. Is it different, too, in our ability to manage this tremendous deficit?
I think, though, that if you have a lot more domestic savings through both increasing savings and paying down debt, you end up in a situation where the deficit it can be funded from domestic resources rather than foreign resources, and that makes a big difference to its stability. You know, people worry about the U.S. government deficit. Yet Japanese funding, the currency is seen as strong. Well, the Japanese government has had a deficit bigger than ours. It's got a level of government debt to GDP higher than ours.
the U.S. isn't headed towards Japan in terms of what they've seen.
Now, there's another part of the playbook that I don't think we're going to get because we have a much more adaptable and flexible economy than theirs. So I don't think we'll see 20 years of deflation like they've seen. But I'm really pointing to one part of their playbook, which is the ability to fund the deficit domestically. I think we're headed there.
But you have talked to us that you're more concerned about deflation rather than inflation in this environment.
Yes, and that really goes with the adjustment in the economy. If it happens too slowly and if consumers save too much, and if the demand fizzles out after the initial boost from the inventory cycle, yeah, you could see deflation. I'm much more worried about that than inflation. I think inflation ain't going to happen because there is a lot of excess capacity in the economy.
Okay.